Alphabet said the magic words that every investor loves to hear about a company they invest in. And those words were that they have demand that exceeds supply in a certain category for its business. And of course, that's positive for many reasons, which I'll talk about in this video. So let's look at this trend line here and why it's beneficial for Alphabet stock investors.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So in discussing the company's developments on artificial intelligence, they said that they're using their own AI tools to how we run the business, whether it's the code, whether it's writing code with AI, or even running some of their key processes using their AI tools. So they're already internally using their AI developments to help enhance the business just for themselves without even thinking about selling it to other customers. They also said that they recently launched advertising within AI overviews on mobile in the US, and that builds on their previous rollout of advertising above and below the AI overviews. And as they talked about before, overall, they see monetization at approximately the same rate as from before when they just had regular Google search results, which I think gives us a really strong base on which we can innovate even more. So that's great to hear because investors have been very, very attentive to its Google search business and how AI is impacting that business. So it's good to see that the AI overviews initiative is going well and they're rolling it out to more and more segments of the business. But here's the part where they talk about supply and demand. So in discussing their AI business, they said that they exited the year with more demand than we have available capacity. In other words, more demand than supply. So they're in a tight supply demand situation and they're working very hard to bring on more capacity. And they've already increased capital expenditure in 2024 and they're going to increase it again in 2025, and they'll bring this capacity throughout the year. So let me talk about why this is good for Alphabet. So when you have a situation where you have demand that exceeds supply, as a business, that gives you a lot of good options. What Alphabet is choosing to do is add more capacity so that they can meet that demand, so that they don't have too much demand and not enough capacity. Because when you have this situation, it could also lead to your customers going to other businesses to buy the thing that they need because you don't have enough. But the good news for Alphabet is that neither does the competitors. This situation is pretty similar throughout the cloud segments. Whether you look at Microsoft or Amazon, there's more demand for AI computing than there is supply. And that's one of the primary reasons why companies have been so aggressive in spending on capital expenditure to bring more supply on. As Alphabet said, they spend $50 billion in CapEx in 2024, and they're going to spend $75 billion in 2025. So they're adding more capacity. And the good news for investors is that since there is demand already there, when they add the capacity, it's going to generate more revenue almost instantaneously because the demand is sitting there waiting to be fulfilled. And that's likely to be the case for several more years to come because growth in this category is so rapid. There's so much incremental demand in this category. The use cases continue expanding and the situations in which people are using artificial intelligence continues increasing. And one of the good things about this category is that it's lifting itself in a positive virtuous cycle where you can utilize AI to make every person more productive in their work, which then increases a company's productivity, which increases earnings, which then leaves more money that they can invest in AI, which then feeds on that cycle again. And this can continue for several years because the innovations in this category are just getting started. It's not like CPUs, where CPUs, they've harnessed most of the available improvements and the rapid rates of improvement in the CPU technology, it's not increasing as quickly as it was, let's say, 15 years ago. With GPUs, which is what AI is based on, these high performance computing data centers are based on GPUs, and those are just getting started in terms of the innovative improvements. So every year it's improving by leaps and bounds. And so it's creating this further use cycle where the technology is improving. And so that's creating more demand because more use cases are being developed when the technology is improving, and then that creates more demand and it feeds on itself. So it's great to hear this going on. And then what another option Alphabet can do, let's say after 2025, after they spend $75 billion in 2025, they say, okay, you know what? We still have demand that exceeds supply, but instead of spending more money, adding more capacity, let's take the more cautious approach and let's just raise prices instead. So that's an option you can do when you have supply that exceeds demand. You have so many customers, you know you're not going to be able to serve all of them. And as is usually the case, when you raise prices, you turn off some customers, right? Usually, if you remember from your economics introductory course, when you increase price, supply drop. I'm sorry, when you increase price, demand drops. And you might experience that yourself when you go shopping for a product. You see the price has increased, your willingness to buy that product decreases. And so Alphabet can do that and still generate growth in revenue because they're not losing any existing customers. Those customers that are leaving are going to be replaced with the other customers that are waiting in line. And so overall, it still serves the same amount of customers, but with a higher average selling price each customer. And so that's another way it can grow its revenue. So that's just two reasons, and there's many more, why it's great to have demand that exceeds supply, because it gives you several good options as a business. Either of those options that I had talked about is a good option. You increase capacity and then you already have demand, and so now you're serving more customers. Or you can choose to not increase capacity and raise your prices because you know you have all this pent up demand that they're not able to fulfill, and you know the customers that leave will be replaced by other customers, and so your overall average selling price will increase and your overall revenue and profitability of the business increases. Either option is great for investors and great for the company. So great to hear these things from a company that I own shares in and I've recommended as one of my top stocks to buy for a couple of years now. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.